Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Paul Winterowd. Thanks for being on the show, Paul.
Hey, great to be here. Excited to chat with you today.
Paul specializes in multifamily debt solutions for investors and syndicators. He's the owner of multifamily real estate as both a general partner and limited partner. He's working on playing 500 different golf courses, and he has 200 in the books this far. So, Paul, thank you for sharing that as well. And I'm looking forward to getting into this conversation about debt solutions because it is such an important part of this business. But give the listeners a little more about who you are and what your focus is.
Yeah, definitely. Just to correct you briefly, 280 golf courses is how many I've played. So I do deals all across the country, work with people all across the country. So it gives me a good excuse to get out and play a new golf course or two if I can come visit a new client. But I'm based in Salt Lake City, Utah. I work with a company called Bonneville Multifamily Capital. We really specialize in multifamily finance. And I know there's a lot of different ways to syndicate, but that's the area of focus that I'm in is the multifamily finance side. And we're not a balance sheet lender per se, really that mortgage broker, capital advisor. We've got a lot of different sources of capital and resources and loan programs. And that's really where I live and breathe every day is understanding the different loan programs and really understanding what my clients are trying to achieve and accomplish and bring those solutions to bear.
Nice. So, and you and I were talking briefly before this, and I like that your expertise is in the debt and the financing side. And because I know a lot of listeners are, like we don't always have the knowledge or the understanding of that part of it to really think strategically about how we can use different types of debt, in these deals or think differently than maybe what most of the industry does. But I'd love for you to just explain or elaborate on some different types of debt a little bit. And let's get into maybe some strategic ways of thinking about the debt and how we can use that maybe in other ways that the industry is using right now.
Sure. And I get it, right? You want the best terms, you want the lowest rate and the least fees and all those sorts of things. And there are trade-offs based on different programs and what you're trying to achieve. And certainly as syndicators, leverage is a tool to create greater returns, show higher IRRs and those sorts of things that help promote the deal, certainly. And we get very focused on the front end of that acquisition financing. And, your typical syndication is that 5-year hold. Hey, let's get in, let's add the value, enjoy a few years of cash flow, and then ring that cash register and move on. Well, there are consequences to that. And we met a couple months ago, had some nice conversations. And after you invited me to be on the show, I started thinking, well, how can I add value or how can I have a unique perspective here and not just talk about different loan programs, but more on a strategic basis. And what really resonated with me is actually thinking of debt on that backside and how can we think strategically at that 5-year mark rather than just sell. And it's not going to be right for everyone. I get that, but just food for thought and a different way of thinking of things. What came to mind was actually one of Aesop's fables. Aesop was a Greek philosopher and storyteller that lived 600 BC. So these ideas and these concepts have been around for not only centuries, but millennia. And so there's a reason that some of these stories endure. And the one that came to mind was the goose that lays the golden eggs. As the story goes, and most of us are familiar with it, but a farmer and his wife have this goose and it's laying golden eggs. And it's, how cool is that to have a goose that lays golden eggs, right? And what do we do in a syndication? We buy a goose that we work on and we nurture it, and then it starts laying golden eggs. And right when it's laying golden eggs, we start just like the farmer and his wife. Well, if it's laying these golden eggs, well, it must be full of gold inside. So let's kill the goose and get all the gold right now. And so I think we can fall into that same trap as syndicators and say, okay, I want to extract this gold, but the moral of the story is they kill the goose, and then there isn't necessarily that gold inside, which doesn't translate 100% in most syndications, because there usually is that bump on the back end, but then there's no more golden eggs. And so how can we look at things to preserve that goose and to create that ongoing value and those golden eggs well into the future? Does that make sense?
It does. I really like that analogy as well. Even that fable that, we killed the goose because we want all that now, but then it stops, right? It's done.
Yeah.
It's done. And
Yeah.
so, it's really just thinking long term. And I was reading a book, I was flying on a trip over the weekend, and I was reading this book, and it even talked about, most successful people, are long-term thinkers. They're thinking long term. Every decision they make, they're thinking long term. How's this going to affect me now? But how's it going to affect me 10 years from now? And so I like that analogy a lot. And so, can you elaborate on, in this, 5-year hold? I mean, that's like the industry standard, it seems like, that most people are thinking about this 5-year hold. But, maybe some ways that we should be thinking differently about that and the debt for that.
Certainly. And just to echo your thought there, I go back to Warren Buffett, right? Everyone's familiar with Warren Buffett, and he's not necessarily big into real estate, certainly an equity and a stock guy, but he does not necessarily invest for value. He wants to find something that can create that cash flow and provide great returns on a cash basis, rather than just buying a company and then hoping it goes up and selling it and getting the gains that way. So he's looking for that. And so he's done pretty well. And as you look around the industry, real estate can be a generational business, right? And the families, the companies, the groups that really build something substantial have that mindset of simply holding on. They keep that asset, and may not be as sexy or as exciting, but certainly over a long-term basis can really be significant and substantial. So yes, coming back to the question, how can we use debt on a strategic basis after that 5 years, or maybe 3 years, or maybe 7? We go in, we add the value, and we make it happen. So one of the things that we do and here at Bonneville is we're a HUD map lender, and there's a lot of different thoughts and ideas around HUD financing in the marketplace. If you dig right into it, the terms are very appealing to almost everyone, and there's some trade-offs in working with HUD, and we'll dig in a little bit after that. But what we can do with a HUD loan is we can go in and we can do, on a cash out basis, do 80% loan to value based on a market appraisal after you've owned it for 3 years. So you can go in, add that value, and then you're looking at an 80% loan to value at that point, and it's very easy to extract all that equity that you syndicated on the front end of the deal. And so that's when it becomes really compelling, and sitting in that limited partner seat. If you look at that, I mean, what do we want as limited partners or investors in syndicated deals? I know from my perspective, I want a return, but more than anything, I want that money back. I just want to know that I didn't lose, right? We hope for a great return, but no matter what, I just want that money to come back to me. Let's look at this HUD program. We're 5 years into a syndication, and we have an ability to go to 80% of the value of the property after you've done the improvements. pull that out, return that cash to the investors. And then now you're holding on to this asset. And you're really in that infinite return space. Robert Kiyosaki talks about this in his books, and what could be better than the infinite return, and that, there's really no risk at that point. Well, investors are certainly going to be happy, and they're definitely going to be inclined to do that again. But by going that refinance route, you do avoid those capital gains, that tax obligation, and there are transaction costs to financing, but typically they're a lot less than the actual sale transaction costs. And so you're preserving some capital there as well. And then also as a syndicator, if you're disciplined, you're looking for the right deal, well, you might have a deal come to fruition, and that investor needs to redeploy that capital, and it may go elsewhere, and that's okay. We're all in this together, and it's not you don't want to have a scarcity mindset. But a couple other things that's nice about the HUD loan, that we actually do those on a 35-year term and amortization. And so your typical Fannie Freddie is on a 30-year amortization, but you have your 5, 7, or 10-year term. So you have this forced balloon payment or some sort of action that needs to happen. Well, that 35-year AM is going to increase your cash flows, but it also gives you complete control of when you recapitalize or refinance down the road. And most agency debt is on a yield maintenance prepayment structure. You prepay that early, that's a pretty hefty bill. But on a step down, that's what the HUD loans are. It's a step down prepay. It's a lot smaller. So it just gives you a lot more flexibility to choose when you recapitalize, or maybe you just keep it indefinitely and you don't have to really, you can set it and forget it.
So let me think about this just a second, so the listeners are on
Sure.
board as well, and maybe simplify just a little bit. So, instead of having, say, that 5-year hold, we may plan to do a refi in year 2 or 3, and really give investors their capital back. But then,
Exactly.
but then plan, so they have their capital back, like you said. Ultimately you want that back, so you're not losing. However, but then don't plan to sell in year 5, but plan to just hold the property. And then, like you said, you plan. Investors are getting that return just forever then, or as long as you hold the property. And then you control when you do another refi or like you called it, recapitalizing the property. Or is that correct? Am I following you?
Absolutely. Right. Generally, we're in good times, right? We've had a nice long run in the markets, and there's the debt markets have been robust. There's a lot of capital out there, but what happens to your syndication when your note comes due in February of 2009, right? Horrible time, right? Cap rates have gone up. There's no debt solutions, and then all of a sudden, you're forced to do something, and that's where I've had a couple clients that really got decimated at that time because their balloon came due at the wrong time. So it's something in the back of your mind, and not necessarily always at the forefront of syndicators, because we find a deal and we've got to do it, and we're not necessarily trying to time, and we don't know when the markets are going to correct and that sort of thing. But whatever we can do to take back control of that, I think is just a wise approach from a syndicator standpoint to be safe. Because again, the worst thing you want to do is have it go bust and lose the investors' money, right?
Of course. So, thinking about, I guess changing this mindset a little bit from this 5-year hold that everybody's kind of stuck on, or I hear like 5 to 7 years, so how do you approach that conversation with investors, or maybe some typical concerns they're going to have?
Sure. I think you really need to just sell the vision that, hey, we're going to look at multiple exit strategies. There isn't just one exit strategy. and selling may be the primary one, and that may be the one that makes the most sense and the one you move forward with. But communicating with your investors, which is always a good thing, no matter what, about, hey, we're exploring different options, and we want to do what's best for you and for us, and explaining this concept. Well, if this makes sense, and it does have to make sense at the time, we have an opportunity to create something to create this goose that lays golden eggs, and see how they respond, and just gauge their feedback. You know, there's lots of different scenarios, and another I wanted to mention, at least make note of, that we're seeing, and I'm doing a couple loans currently that have taken this strategy. It's really rolling into a full term interest only play. And so this isn't necessarily a HUD loan, but with the agencies as well as CMBS, and CMBS is currently being a little more aggressive here, but there are options in both fronts where, hey, again, let's back up. You go in, you create this value, even with max leverage on the front end, but you've created all this upside on the back end. And to qualify for a full term IO scenario, you've got to keep it at a 65% loan to value scenario, and you've got a little higher debt coverage ratio to hit. But you've created that value, and now you go into maybe a 10-year or 12-year full term IO, and you're just juicing your cash flows. You're 2x, 3xing your cash flows by not having that principal pay down every month. And again, you know, that cash on cash becomes 8, 10, 12, maybe even 15%, right? And again, very compelling. You do that for the long term. You say, okay, hey, investors, we've got this alternative where we think this makes a lot of sense. We're going to double, triple your cash flow that's going to continue to grow over the next 10 years. Would it be worth it to you to leave your money in there? Absolutely. I don't have to go find another deal. We've already proven this out. We've got this goose that's laying golden eggs. Let's just harvest the eggs.
So would this full term interest only or IO be at the beginning or when we purchase the deal, or is this something, okay, we're going to do a refi in year 2 and then move to interest only?
Yeah, great question. It's tough to do on the front end. It might work on if you're building new construction, and then and that would be your takeout loan, because typically you're creating a lot of value. But with the full term IO, we do have a 65% loan to value, and so most syndicators that we work with and that I've seen are looking to maximize that leverage, which obviously increases the projected returns and that sort of thing. So certainly a good approach there. I do have a client that is more conservative and raising more capital, and it is more of a cash flow play. So it could be either side. What we see more in the marketplace is this maximized leverage initially, and then on the refi 3, 4, 5 years down the road, that's when, hey, rather than selling, we can put a full term interest only on this for 10 years and just, I'm going to double your check, you know, next month or next quarter. And that's going to be what it's going to look like. Is that compelling? Well, yeah, why not? Let's do it. So typically on the refi side, on that back end strategy, more so than the front end, but they could work for both.
Yeah, because then we paid the principal down, and then we're going to have a lower or higher, hopefully higher value by that time as well.
Yeah.
And so
yeah, that's it. You got to create the value for that, and you know, you may be able to pull some cash out, maybe not the full cash out like in the HUD scenario, because you have to hit that 65% loan to value, 1.35 debt coverage rather than a 1.2 or 1.25 on your typical loans. But it's a great option for the cash flow, and really worth considering.
Yeah. What are the cons of doing this interest only type debt? I hear people say, oh, that's too risky, or, we're not paying down the principal at all. What are some considerations there that we need to keep in mind?
That's just it. But again, we're looking at, hey, now you're at 65%, Well, your plan is to continue to raise rents over the next 5-10 years. And so you're creating more net operating income, which creates the value. And so you're really, over that projected time frame, you're going to get to maybe 60 or even 55% loan to value as that value increases. And so really different strokes for different folks, but I certainly don't see a lot of downside in that if you're a hold type investor. The only real trade-off is that you're leaving more cash in the deal. So if you had a better place for that or wanted that cash out, that would really be the trade-off. But from a risk perspective, or worrying about not doing any principal pay down, the way that the loan programs are structured and the metrics you have to hit on the front end, there's really not a lot of downside risk on that side of things.
So, a few questions before we run out of time, Paul, but
Sure.
what's been the hardest part of this syndication process, especially on the debt side for you?
Well, there's a lot of options. When talking about syndication, the hardest part, I think, and maybe really the key to success in this game, is actually doing it, is actually getting in the game. I field a lot of calls. I've fielded hundreds of calls over the course of my career, people that find us online or referred to us, and we talk to them, and a lot of people want to be in this game. And it's so easy to look at the syndication game and be, hey, that looks cool, that's sexy, there's a lot of money there, I want to do it. And a lot of people just don't. And I've had clients that may have been less sophisticated or didn't know everything, but they took action, they jumped in, and they figured it out. A little bit of building the airplane in the air, and in my own experience, I've done that to some extent as well. But getting in the game is really, I would say, the hardest thing and the biggest factor of being successful. Is as simplistic and perhaps unnoteworthy that might be. It's really just doing it. And I see a lot of people that poke at it or look at it and really don't do it and never get those gains, and others that have stepped in and they're increasing their net worth, their cash flow, they're growing, they're doing more deals, they're learning and progressing because they're in it.
I love the analogy of building the airplane while you're flying, and I can relate to that, getting started as well.
It's what we all do, right?
Yeah, so many things you have to learn, and you got to jump in and commit and get it. I love the even that analogy of thinking about the commitment. Like, okay, you're already flying, you don't want to crash, right? So
Yeah.
you got to get that thing running. So I love that. And so tell me, how do you prepare for this potential downturn or recession that everybody's talking about?
Oh, that's a great question. I wish I had that answer. There's certainly the old mantra, and we go back to Warren Buffett, cash is king. I don't think it's a bad idea to have some cash reserves, but I also think we don't know when it's coming. And, we're well beyond when it should have happened. I've been to economic conferences for 3 or 4 years in a row now, and every one of them, well, the recession should be here 6 months from now. Well, you hear that every year, and it doesn't come. And that there will be corrections. There's cycles. We understand that, but having some cash inside on the side, but also coming back to what I said before, you want a track record. We can't, if you haven't established a track record, if you haven't done any deals, if you haven't been in the game, things go down and you're like, okay, now I'm ready. Well, you're an unknown entity. And how much harder is it going to be to raise funds when funds aren't as abundant? You need to have a track record and know what you're doing. And so I think it's twofold. The best way to prepare is don't spend all your money, keep some on the side, have some cash reserves, but also get in the game and stay active and build up that reputation. So if that correction comes, you're more poised to take advantage of that. Because I've made money, you've made money, a lot of us have made money over the last 3, 4, 5 years, but the guys and gals that made a ton of money were doing syndications in 2009, 2010, 2011, when everything was on sale and people were scared, but that's best way to prepare.
What's the way that you've recently improved your business that we could apply to ours?
A book I've been studying and it's really resonated with me is called The 4 Disciplines of Execution. And some people may have heard of that, but it's talking about leading indicators versus lagging indicators. It's easy to look at our cash flow or our production in our day job, but that's a lagging indicator. We need to identify the leading indicators. So, what and how to measure those. So if we're trying to build a syndication business, well, we need investors, we need partners. So something to track is how many phone calls or how many meetings you're having to build that database and those relationships. And that today it might not look like, hey, I got a syndication, but you're doing those things that are going to lead to those results. So figuring out those leading indicators, those inputs that yield the outputs you want, and measuring, tracking, developing those is something that's helped me. It's something I continue to work on and feel is really important to building a successful business.
Who's the author of that book?
A couple authors. It's Chris McChesney, Sean Covey, and Jim Hewling.
Awesome. Just wanted the listeners to be able to find that book. It sounds
Sure.
very interesting. So what's your best advice for caring for investors so they want to return to the next deal?
Certainly communication, I think, is key. I've heard it on your podcast, other syndicators. It's out there, but communicating, rain, sun, or shine, what's going on, keeping people informed. That's what we want. If investors are they're going to fill that void, they're going to have questions on what's going on, and much better if we're helping them understand that narrative and what's going on, rather than leaving a blank slate. And it's easy to go to a worst case scenario in our minds if we don't have that information. So certainly communication is key.
And what's the number one thing that's contributed to your success?
Coming back to what I said before, I got to practice what I preach, but jumping in and doing it. That is not earth shattering, but that's the key. Things certainly changed in my life when I took that action. It wasn't necessarily comfortable or easy, but taking action, closing that first deal, really does change your life. So it certainly changed mine, and so that's my best advice. There's no silver bullet. Just get in and do it.
I love that. And tell me how you like to give back.
One thing I love about the loan business and my mindset is simply the opportunity to visit with people and help people understand their options and educating that way. Love community service. I've been involved in several Sub for Santas and those sorts of things. This is a great time of year since the holidays are approaching for me, and certainly through my church, I like to give back and help out.
Wow. Well, I appreciate you sharing that, Paul, and just, really thinking about a debt and the pros and cons of different types of debt, and even thinking outside of this 5 to 7 year hold that seems like to be an industry standard. And, and even the book that you recommended, and even how I think you mentioned a group using interest only, or doubling or even tripling investor returns. And that's by using different types of debt and thinking more long-term. And so appreciate you elaborating on helping us get out of that mindset, or opening our minds a little bit to some different debt strategies. But tell the listeners how they can get in touch with you and learn more about you.
Sure. Email or phone are the best way. I do have a newsletter, and if you email me, I can add you to that. It's Paul, Paul, at bmfcap.com. So that's bmfcap.com. And you can also give me a call, 801-323-1050.
Thank you for listening to the Real Estate Syndication Show, brought to you by Life Bridge Capital. Life Bridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. Life Bridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.